Welcome to Chat with Hey. As usual, before you continue watching, I'd like you to subscribe, to follow, to comment, and to share to empower someone else. Today, look at one critical questions that I've been receiving a lot of late. That is, what kind of investment should I put my money in? Should it be treasury bill? Should it be mutual fund? Or it should be stock? I've received a lot of questions in that area, and so I would like to do a video to explain and provide some guidelines in that context. First of all, the investment decisions start with investment objective. What do you want to achieve? Do you want capital preservation? You don't want to lose your money. You want your money to stay as it is and grow little by little, or you want to achieve rapid returns or high returns. You want your money to grow exponentially and quickly. It all starts with your investment objective, what you are trying to achieve. It also looks at the timeline horizon that you have. How long do you want the money to be in investment? Do you need the money? Is it a retirement fund you are building and so you have long-term use for the money? Or you want to use the money in 6 months, so you want your money to stay in investment and give you some returns within 6 months. Your time horizon also determines where you should put your money. So on those three investment instruments that I've had questions about, the first is the treasury bill. Treasury bill principally is lending money to government, and when you lend money to government, you make returns on the amount you lend. Typically, treasury bills are low risk instruments, and so the probability of you losing the amount you have put into the treasury bill is very low because you are lending to government. Now, because it is low, the risk is low, the return is also usually low. As we speak today, the 91-day treasury bill is in the zone of about 4% in terms of per annum, in terms of the returns. And then the 182-day bill is also within the range of the 8s and the rest. And so you realize that there is not much that you get in terms of the returns for treasury bill. But what it does is that it preserves your capital and it gives you some moderate return on your investment to grow it. And so if you are the type who you intend to patiently put your money to preserve it because you are waiting to use the money for something, an objective that is coming up soon, then you could consider treasury bill. The other instrument which people have asked about is the mutual funds. How the mutual funds work is that the mutual fund had fund managers who pool resources together. So anytime you invest in a mutual fund, what you are doing is that the company is pooling person A, person B, person C, person D's money together. And when the company pulls all the resources together, they invest in different types of assets. They buy treasury bill with some of them, they buy fixed deposits with some of them, they invest in stock with some of them, they put in other investment instruments with them. And when they have achieved and raised the resources, they pay returns to the investors over a period of time from the yield or the returns that come from the investment that they have made according to the units that your investment has actually procured. So mutual fund gives you the potential to diversify your income. It gives you the potential to get something higher in terms of return, higher than the treasury bill because of the diversified assets that they put the money in. And it is usually managed by professionals who know what they are about. And so the likelihood of putting it in an asset that is likely stable is also very high. And so you may consider one advantage of mutual fund is that it allows you to invest money in bits and pieces over a period of time. And so you can start with small amount, 500 CD, 100 CD, 300 CD, and be investing every month. You can add some every month, you can add some. Treasury bill does not behave that way. Treasury bill, you need one amount and put in until the tenor is over. But for mutual fund, you can keep on depositing over a period of time, and you are able to mobilize a lot of money over a long period of time. And so when you are dealing with mutual fund, you can decide to be a bit patient with it and add to it over a period of time, and it can generate growth for you. The other instrument that people have asked about is stock or shares. Now, when you buy shares in a company, usually if it's a public traded shares, you are buying part ownership in that company. So what happens to you is that when the company does well and make profits, they are able to pay you part of the profit as dividend. That becomes the return on the investment you have made in the company. So the downside is that if the company doesn't do well and they don't declare profit, then you don't get any returns on the investment. The other thing that can also happen is that if the company doesn't do well and goes into bankruptcy, you can also lose the capital you have put in the company. But in the long term, if the company does very well, you get dividends as a return and you get capital appreciation. Because if the share capital on the stock exchange does very well, let's say you buy a stock at 2 cedi per share, and over a period of time, maybe 2, 3, or 4 years, the company does very well and the share capital move from 2 cedi per share to 5 cedi per share, the difference of 3 cedi per share is your capital appreciation. So beyond the dividend, your share capital has also moved up. And so if you have a large quantity of the shares you have procured, it means that you get a lot of gains from it. So these are the three options you have. Look at your appetite, look at your objectives, and stay informed before you take the decision. Thank you for watching. In our next session, we are going to look at one interesting thing about what financial funds, the type of funds that every individual or every family must keep to be financially successful or to create wealth. You must make sure that you have developed, built, and funded three types of funds for you to enjoy financial stability. Keep watching, and God be with you. Thank you.